This is Rod Kusanen, Spooman with Risk. We're going to be discussing our manual workspace. We do have a strategy on it, and it's doing reasonably well. But I'd like to talk about how to use this workspace from the standpoint of manual trading, because there's some excellent strategy concepts that we have available to our users, and we'd like to go into some detail on each one of the individual charts. Now, what we have in the upper left-hand corner is a chart that basically summarizes the data feeds that we're trying to track, along with specific rules that are applied to our strategy. We'll get into that later. But let's just quickly go over the individual charts in this workspace. Now, number one is the composite chart on which our strategy sits. Number two, we have the tick. Chart number three is the tick of the S&P. Chart number four is the tick of the Russell. Chart number five is the advancing issues of the S&P. Chart 6 is the ESINX E-mini premium. And then in chart 7 and 8 we have a variety of different VIX data feeds. The VIX.X in chart 7 and the the VXD.X in chart number 8. The concept that I'm about to describe will apply quite well to any of the tick data feeds. So whether we're using the tick of the S&P or the tick of the Russell, the concept that I'm about to describe is applied to each one of these. So we'll just use the tick of or just the tick itself with the data feeds on this. We'll expand it out and go over the concept. Now, the first thing that you'll notice is that we're charting the tick on a 50 brick Renko. It makes the pivots, they're very, very clear. On this data feed itself, we've plotted a zero line in yellow, and then we're running automated Fibonacci retracements on the pivot points of the tick. We are only using a zero line, an 11.8% retracement, a 23.6, a 38, and then we jump to a 76, an 88, and a 100. So we're eliminating any of the Fibonacci retracements between 38 and 76. And we notice that the pivots there are relatively predictable. Now, let's go to our next, our first subgraph. On this subgraph, we're running a Zurich stochastic set to 5 and 150 on the 50 tick or the 50 brick Renko. We've adjusted the Zurich stochastic so that we can see more readily where the stochastic is entering into a overbought or oversold zone, and by that we define the overbought as being at 100 and the oversold at 0. Slow K and slow D will plot a different color once we reach that level. And when it does, it becomes a very highly predictable pivot on which to take a trade. In addition to that, the subgraph number 3 is the detrended price oscillator. Now it will respond a bit more quickly than the stochastic will, and oftentimes we're able to see a divergence on the DPO quite readily, and making it a little easier for us to take a trade. The next subgraph, we're using a modified z-score. Now when I say modified, we have set up this particular z-score so that it plots the z-score into a different color when it reaches a certain predetermined level. For example, down here, the color of the z-score has changed to red, and that's because it is now below 1.3. Now in the z-score itself, you can, let's just get it over here. If you can see this clearly, you'll notice how certain levels are now painted red when they're overextended. When the standard deviation is too high, we change the color. Now we arrive at that color just basically by looking at where the pivots generally change direction. So for example, right in here, you can see the average z-score at its maximum was at about 1.28. So what we've done to the indicator itself, we now allow the user to go in and modify the, let's shrink this down a little bit. You can go into the indicator and establish a level at which the color will change. Now we've set this up currently to a 1.35. By just simply looking at where those pivots change, you can just come in here and then change that number based on what the current readings seem to be pivoting off of. So we may want to reduce that. These were based upon previous day's activity. And then just change them and save it, and you're done. So this again helps us to see where those pivots are most likely going to take place given the overextension of the z-score. Our next subgraph, we're just plotting a stochastic off of the ES100 so that we can have a little bit of an idea of where the ES is at the time that the tick is overextended. In our final subgraph, we're using a Zurich JMA, and in particular we're using a CCX study. And we've modified this as well so that we can see where the CCX is overextended and pivoting. And we've used a variety of different colors to identify where it becomes overextended. But basically, if it gets into the red, the CCX itself is red, chances are at that point in time we're getting very close to being overextended, and a likely pivot will take place. So now when you combine these different indicators, it's fairly easy to see where the tick is going to change direction. Correspondingly, we'll be seeing a change in direction of the ES, and therefore an opportunity to take a trade. So let's consider a few examples of this. Let's just go back here to the first indication over the past hour or so where the tick became overextended. And we can see that because the stochastic got into the overextended zone. It was at or 100 on slow K. Slow D didn't quite make it to 100. Well, yes, it did, right there. Now, of course, if you're familiar with Jurek, they really don't have a slow D. They have a fast K and a slow K. But most people are familiar with the concept of it being either slow K or slow D. In any event, we're overextended here. Now, we're also overextended on the CCX. We're not really overextended on the Z-score based upon the previous setting at 1.35. The DPO started to pivot here as well as in here, and then ultimately here. And here was a real nice situation because you could see divergence on the DPO. Well, pardon me, not so much on the DPO, on the Z-score and the CCX. So whether you were entering a short trade here or ultimately here, there's where you've got a real nice divergence on the CCX. You see the same divergence on the Z-score and a nice opportunity to pivot. So entering a short trade anywhere in this neighborhood is going to make some sense. Okay, and again, using the overextended, overbought level on the ES 100, where it's entering into the red, that gives you a pretty good indication that right in here, that's where your first trade would be. And then really over here, maybe adding to that position would make some good sense. Now, when might you take another short trade? Well, the next time that we get into that same situation is right in here. Okay, right in here. The CCX is overextended here, as well as here, and then again, big divergence right there. Let's look at a third. Well, let's look at a long trade. We come down here and we're oversold on the tick. The tick is now turned green right in here. That's confirmed. The Z-score went into the red briefly right there, as well as the CCX being overextended down here. And you've got another opportunity right in here, and a nice divergence on the CCX as well as on the Z-score. See a little bit of that divergence on the DPO as well. So you can, relatively speaking, pick your entries based upon the concept of a confluence between these different indicators, namely the stochastic of the tick, the Z-score, and the CCX. It's fairly easy to see. And if you're of the mind that divergence is what you need to see to take a trade, that divergence is fairly easy to identify as well. So we like to use the Z-score for the purpose of divergence, but we're seeing that the CCX indicator works pretty well as in addition to that. Now we had another opportunity for a short right in here. Overextended, Z-score didn't quite make it, but there is a divergence here in a manner of speaking, because when you compare this high, all right, where the Z-score is overextended, to this high, got a lower high on the Z-score, but a higher high on the reading of the tick. And you've also got a nice divergence here, comparing these two. So taking a short trade, for example, right here, let's take a look at what that would have accomplished. At 11:05, let's take a look at where the ES was, right at around 11:05. There's your 11:05. Market at a high of 18, dropped into 15. That's a 3-point potential move, but you can see how that works. Okay. Now we'll quickly discuss the same concept using the tick of the S&P and the tick of the Russell. We use we don't pay any attention to a zero line on the tick of the S&P. It seems to be pretty much irrelevant. But we're running an automated Fibonacci retracement on this to give us an idea of where the pivot points are likely going to be. So when you're taking a long trade, you want to be in the lower range of the Fibonacci. Short trades in the higher ranges. So above 76, below 23 here has been working, or roughly at the 23.6 range. That seems to have been working fairly well. You can see numerous places where it started to pivot long. But let's take a look at the indicators again. CCX, excuse me, the stochastic. Now here we've set the stochastic range to, let me just pull this up. We're using a slightly different length here, 10 and 50, as opposed to what we were using on the tick. And we find overbought here, as well as in here. Then again in here, a little bit of divergence there. The Z-score, color change is based upon what we're observing on this data feed. So we're using a slightly different level at which we're going to paint the color of the bars red. We were using 1.35, and here I think we're using 1. Let's just bring this up. No, I'm sorry, we're using 0.6 and negative 0.6. Again, this needs to be adjusted one day to the next. Just take a look at where the pivots most likely were, and then just go in and make an adjustment on the indicator, and that will then allow you to see more what the current pivot points are. The CCX, overextended here, 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 and again here. So this really confirmed that 1105 pivot that we just talked about. Overextended on the CCX, on the Z-score. Didn't make it on the stochastic, and we would consider that to be a divergence. So this was confirmed on the tick of the S&P as well. Now the other data feed that we've got working here, we've got a stochastic set to a little higher the data feed here. I should have gone back and mentioned this S&P is again a Renko 50 brick size. This is based on a 100 brick size. And again, we're just looking for where we're finding ourselves to be overextended. So we get a little bit different reading using this setting. But we've got a nice confluence there using this particular stochastic setting. Good time to take a short trade. Nice 3-point move, and we expect more out of that as well. So the same concept then applies to the tick of the Russell. Overextended here, 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 a couple of times here on the stochastic. There's your Z-score and your CCX. So it's not too difficult to pick out opportunities for trading. We do watch a zero line on the tick of the Russell. And you can see why. All right, now just briefly, a couple of other things. Advancing issues on the S&P are being plotted here. We use a very fast 5 brick Renko, and we're using a very long length on the stochastic. We're paying a little bit more attention to the slope here than we are just to the overbought or oversold ranges. But you can see the same concept here applies when it comes to the use of the stochastic as well as the CCX. Now we don't run the Z-score on here because it's just too noisy. But you might choose to do that if you want to give it a try. But I'm finding it to be a little bit too noisy. So I'm just looking for the stochastic as well as the CCX to become overextended when it comes to looking at an opportunity for a trade. Again, right in here, right in there. Where were we at 1105? That was your 1105. And that was confirmed on the advanced decline. Or, excuse me, the advancing issues only. Only plotting the advancing issues. There's no point in plotting the declining issues because it's just an inverse relation. Now the premium here, we always want to know what fair value is, so we're plotting the horizontal line at the current fair value. We get that off of programtrading.com. We're running a Z-score on this, concept being when the Z-score drops below the zero line, you're short. If it's above the zero line, you're long. And it's pretty much just that simple. And then as far as the VIX is concerned, well, let's just take a look at this. I like to look at the VIX as more of a confirmation. The VIX tends to lag a bit, so I'm not going to be as quite as concerned about the VIX agreeing with the other data feeds. But it's interesting to know here, we've got 4 different VIX data feeds. We've got the standard VIX.X, the VIX of the Russell, the NASDAQ, and the Dow being plotted here. Stochastic on each of those. And we're running those stochastics using a 0.01 Renko brick. So what I'm going to want to see when I'm taking a trade is general agreement with the VIX. For example, I want the VIX to be overextended into what would constitute an oversold range when I'm about to take a short trade because of the inverse relationship there, and overbought when I'm about to take a long trade. So I plot the actual VIX here, VIX.X, and I've got the VIX of the Dow over here. Now you may not even want to plot that data, but in any case, it's available here. Now, in addition to all of this, a couple of added features in our workspace. Let me draw attention to this particular workspace is plotting the large contract on an 8-tick bar with a fast stochastic as well as a DPO. In addition to that, I've also plotted out gaps in the large contract. And I'm also plotting range bars. And what I find here is really compelling. For example, if the stochastic is moving up, if you just simply look at how the large contract responds, if the slope of the large contract is positive, chances are it's going to get to the point where the stochastic reaches 100. So there's no point in taking a short trade until either the slope is negative or you're close to, or pardon me, I won't even say close to. You want to be up there at 100%. In addition to that, you want to be paying very close attention to the slow K reading. Taking a short trade, for example, down here, I'd never do that. I want that slow K reading to be up above 80%, closer to 90 or above, if I'm going to take a short trade. Unless I'm already completely convinced of the market direction, I would generally not violate that principle. These are good opportunities for taking short trades. Now today, you can see if we were applying that rule, the only time we would have done so would have been right in that 11 o'clock area that we talked about. But the point of the matter is that the large contract, when you're just running this data feed, gives you a real strong basis for making sure that you're trading in the right direction. So either the slope, okay, or getting into an overbought or oversold level is very important. Where do we think the market is going right now? I'm of the opinion that we're going to drop into that 1311.50 range because that's where the gap is. And in addition to that, we've got a range bar. So I expect that within the next hour or so, maybe even sooner, the market will drop down that far. So I'm holding a short trade until we get down to 11.50. Then I'll see where we're at on the stochastic at that point. The range bars are very, very useful. But you've got to make sure that if you're using range bars for entering or exiting a trade, that the slope of the stochastic is in agreement with where the range bars are. So if you've got range bars below the market, you're going short only if the stochastic agrees. And if you've got them above the market, you're only going long if the stochastic agrees. Now this is again 8 ticks. I've got a 0.6 Renko on this data stream. Large contract again set to 0.6. And that's of course because the large contract doesn't trade in quarter points, but rather trades in tenths, 0.1, 0.2, and so on. So here I'm using 0.6. So it's a little bit more than a half a point. But very well defined opportunities for taking a short trade. Just wait for it to get overbought. And once you're there, then we kind of go back to the tick of the Russell, the tick of the S&P, the tick itself, and we refine our entry based upon that. And then just for the purpose of verifying where we're at on the ES, all I'm doing is just showing a fast K stochastic, and generally speaking, I would never take a short trade unless the fast K is overbought. Never take a long trade unless we're at 0. We're either at 100 or we're at 0. That's fairly easily achieved. But if you follow that rule, you'll keep yourself out of trouble. You'll have opportunity, in other words, to get out of a trade without necessarily taking a loss if you just wait to take that trade when the stochastic gets either overbought or oversold. All right, let's see, is there anything else that we wanted to cover? Let's just take a quick look here. Okay, we're applying premium rules here to the 1 minute ES. We've got the VIX being plotted and the highs and lows of the S&P premium as well as the ESINX. Now, some people think that the SPINX is not a very accurate reflection of the premium calculation, and I will agree, but I don't use it for that purpose. All I'm using it for is to determine whether or not the premium hits a new high for the day or a new low. That, relatively speaking, is all that I'm using this data feed for. The same applies for the ESINX, which is a far more accurate reflection of the premium. But I find that the highs and the lows on either of these data feeds become predictable. It gives us a footprint for where the market's going to go. So, for example, this high on the premium here, just indicated we should likely go higher than 1675 before we take a short trade. And indeed, that's exactly what it did. And this low that occurred on the large contract right there indicated the market was likely going to drop. And we're still of the opinion that we're going to continue to drop. And one of the reasons we know that, the low so far was at 1250. All right, low was at 1250. The VIX is continuing to trend up. 90% of the time, the VIX will be at a new high when you hit a new low. So if the market was at 1250 when the VIX was at 2160, now the VIX is at 2172. The VIX is higher, the Spoos are not. The trend is up on the VIX, and it will likely continue in that direction and drop below that 1250 level that we talked about, which was the low of the day. And that'll continue on until we drop below that level. And we're anticipating somewhere around 1150. Now I throw a Z-score on here just to give me an idea of where on the 1 minute chart the premium is either above or below the zero line. It's not particularly useful, I will add, because 1 minute is just slow. But let me show you something that is useful. We've got the fair value horizontal line here at -7 for today, which happens to be the 11th of June. And as you can read on our website, when the premium drops, the bulk of the bars are below fair value. That market is short. If the bulk of the bars are above fair value, that market is long. So right now, you can see that the bulk of these bars, the premium bars on the ESINX, are below fair value. And consequently, this market will continue to drop until that condition changes. So you wouldn't want to even think about going long when you've got that kind of a pattern on the premium. No point in going long at all. You just short this all day long, as long as that condition persists. Okay. So one last thing. Nice little gap there. That's going to drop, fill that gap. What we've done here on the primary trading screen is send the results of the data on the different charts that we had talked about previously. And we put all of that data right here for easy reference. Oh, and incidentally, you see a gap like that, you want to short that thing. See what happened there? Man, you want to just jump on that opportunity immediately, because what you just saw happen, that's exactly what's going to occur. A gap on a 100 tick bar, oh my goodness, I'll short that all day long. Anyway, so let's just go back to that 1105, because that looked pretty good. You could see how on this chart, you don't really need to follow all of the individual charts. You can come right over here and let's just go quickly through the data. You know, the 100 ES tick overbought. It's overextended here on the tick, all right, with regard to the stochastic, and here's the CCX as well. Same deal on the tick of the S&P. The stochastic and the CCX all are in agreement. Tick of the Russell, it's already sloping down. Got a little color change right in here. The large contract, 6 Renko, 6 brick Renko, overextended here. The slope of the 8 tick is already down. Advanced decline right in here. It's changing color. And then I throw a real fast stochastic on a 25 tick bar. And I've set up a CCX as well here. So what I like to do, when I see that my conditions exist, when I'm overextended on these different data feeds, and I don't need them all to be overextended, by the way. I just need one. Either the tick of the S&P, the tick of the Russell. I will not necessarily wait for all of them to get overextended before I take a trade. If I see one of them overextended, I'm willing to enter a trade there. And then once we're here, once we're overextended on the ES 100, I'll come over here and I'll take a look at the ES 25. That will be my entry. I'm going to take a short trade right in here. I'm not going to wait for the 100 to begin to change direction on the stochastic. I'll use the 25. Much better entry. Okay. So, last but not least, if you'd like a copy of our indicators, we're currently running a very interesting promotion. Our indicators are on sale for $9.99. However, if you are new to TradeStation, TradeStation will set up an arrangement whereby you will get a rebate on all of your commissions until such a time as the rebate on those commissions equals the cost of our indicators. So basically you get the indicators for free. So if you'd like more detail on that, you give us a call. We'll go into the specifics. So that completes the subject of our video today. Let's just take a look at one last thing. All right, we had two real nice profitable 9-tick. These are 9-tick profit targets. So we had 18 ticks on those two trades and a 5-tick loss on this one. So we got in a little earlier here. Ultimately that trade worked. It was just misplaced. So I would have looked for another opportunity to get long right in here, as you can see, either right in there. And we have a divergence right in here. That would have worked well. So the strategy is set up for specific rules. It doesn't look for every opportunity for trading, but we're getting good results off of the strategy as well. All right, so that completes this consideration of our current workspace. This is Rod Kusin and Spooman for Risk.